Hi, I'm Lee Stone, and this is your MaxiForex Week in Review. Today, we will cover some of the major financial events of the past week and discuss how they impact the global currency markets. But before we cover headlines of the week, let's look at last week's risers and fallers. The Euro-US dollar pair recovered somewhat from the past 3 weeks of losses. The pair gained 1% this week and was last trading at 1.3684. The British pound performed mixed this week against the greenback, making a rise of nearly 1.5% and closing at 162.33. The US dollar Japanese yen, however, had a bad week. The pair fell 0.43% and was last seen trading at 83.09. Tough times for the US Canadian dollar pair continue. A lot of back and forth this week left the pair with very little changing. Overall, the pair dropped 0.09% and was last trading at 0.9858. Looking at commodities, gold had a decent week. It ended up gaining 0.34%, closing at just under $1,390 per ounce. Meanwhile, April crude orders gained 0.72% and closed at $86.20 a barrel after recording a high of $87.88 and a low of $83.85. In news this week, the highlight was the G20 meeting held this Friday. The Group of 20 discussed lowering currency reserves and compromised on the wording of other indicators in a list of measures that will be used to assess global economic imbalances. Talks in general revolved primarily around current accounts, real effective exchange rates and currency reserves, as well as public and private debt levels. The Bank of England estimates that the UK's benchmark rate will climb to 1.25% by year-end and 2.25% at the end of 2012. Sterling enjoyed a nice bounce after this was announced. The UK 10-year break-even rate, an indication of investors' inflation expectations over the life of securities and is derived from the yield gap between conventional and index-linked bonds, was little changed at 3.18%. In Asia news, China, India, Indonesia, South Korea, and Thailand have all boosted borrowing costs this year, widening the gap with the Federal Reserve's near-zero benchmark rate. As Asia leads a global economic recovery, the International Monetary Fund estimated last month that the developing economies in the region will expand 8.4% this year and next, double the average 4.2% pace of Latin America, and more than triple the 2.5% annual growth in industrialized nations. To discuss more, let's bring analyst Martin Smith. Hello, Martin.
Hi, Lee.
So China looked very aggressive during the G20 meeting. Do you feel that China is aware of its responsibilities in the world?
Well, I believe China is the only country that's blocking an agreement on a set of indicators to measure global imbalances, leaving delegates with much more restricted options to present to ministers. I agree with the Vice Governor of People's Bank of China that China will strive to maintain a balance in international payments by boosting imports and not cutting exports. Now, the head of China's State Administration of Foreign Exchange stated that hot money inflows into China are very small as well. So China's cross-border capital flows are actually in line with real economic activities. The finance heads of the world's major economies are also pressuring China to drop its resistance to making a deal for tracking risky imbalances in the global financial system. This is being done in an attempt to revitalize the Group of 20's affluent and developing nations and avoid an additional financial crisis. China had opposed attempts to use real effective exchange rates and currency reserves to measure imbalances, and ministers made no mention to either as indicators in their own right. So I have the impression that China is aware of what others expect of their responsibilities to the world, but on the other hand, they will likely do what is in China's best interests. The Chinese are aware of how they are also greatly affected by global developments, and for this reason they will remain involved in maintaining and protecting financial stability in their region and in the rest of the world.
Bernanke also repeated his criticism of the yuan policy. What's your opinion on that?
Well, the Federal Reserve Chairman repeated his criticisms of China's limits on the yuan by mentioning that countries with large trade surpluses should let their currencies appreciate to assist the global economy. Now, I tend to agree with Bernanke's statement that the safeguarding of undervalued currencies by some countries has contributed to a pattern of global spending that is unbalanced and unsustainable. These countries should allow their exchange rates to better replicate market fundamentals and boost their efforts to substitute the domestic demand for exports. The changes would help address what Bernanke has called a collective challenge to reshape the international monetary system. I also have concerns that monetary easing in advanced economies is fueling capital flows to rising markets, prompting inflation and causing asset price bubbles. I'd also agree with Bernanke's statement also regarding China that countries with big trade deficits should aim to increase saving, including putting fiscal policies on a more sustainable trajectory. There was no mention of the US or European markets. The Fed chief spoke at a panel discussion with other central bankers hosted by the Bank of France. Paris is hosting the Group of 20's meetings of central bankers and finance ministers in the coming weekend.
It's been a while since we've had an Ask the Broker question, but here we go. Johann Utrecht of Hamburg, Germany writes, there was news this week that the German banks have lowered debt securities. What do you think will be the impact of this on the people?
Yes, the German banks subordinated debt securities valued at 24 billion euros were downgraded by Moody's Investor Services. I believe that they did this due to the prospect that new legislation would increase the risk of losses among debt holders. Moody has cut the ratings of lower tier 2 notes, which are a layer of debt that's subordinated by coming behind senior bonds in the queue for repayment after a bank collapses. Like other governments seeking to ensure creditors pay up before taxpayers have to contribute, German law now removes the protection tier 2 bonds enjoyed from the authorities' preference for saving lenders before they fail. Paribas SA analysts Olivia Frieser and Ivan Zubo have also stated that the new legislation materially reduces the likelihood of government support for LT2 securities and therefore took out the state support uplift. I think the downgrades are as harsh as we had expected, which may weigh on people's sentiment.
Thank you very much, Martin. Well, that is all the time we have for today. We hope you enjoyed our weekly review, and we hope you will join us next week. Until next time, be sure to visit us at MaxiForex.ru.